What's up, Outliers? Good to see everybody. Hopefully, we're all off to a stellar week. For Spindrift, we have Mango Orange today. I guess we're over here because I might stand up. And then we have some watermelon. We have a little bit of everything. So we're locked in, boys. As always, I'd love to see who we got in the chat. I am seeing Tommy, IR Too Bad, David, Tom, and Jay. Great to see everybody. All right, so the agenda for today is light. I am able to really pivot to whatever you guys want to talk about. I have a couple things I want to run through with you all, primarily just some market and portfolio updates. But today I have spent a lot of time looking at a couple different strategies, momentum following strategies, specifically within TQQQs. So that is where the lion's share of my time today went. So yeah, I'm working on refining a few things. I started sharing some of the stuff with with everybody. And then I'm kind of creating a little bit more of a structured data set for some of the Patreon folks. The main thing I'm trying to look at is with stuff like TQQQs, the ability to really decrease participation in the downside is super, super important. So on like a 3 times leveraged product, that is why, like specifically on that, it's very important. And then Wheel Stretch Joe says, what do wings do to a position? Which is a great question. That's actually from the Discord. He has a specific style of trading where he tries to make a certain amount of income on a weekly basis. As much as I try to talk him out of it, he's probably even more thick-headed than I am, which is actually really difficult to come across, I think, because I'm about as thick-headed as they come. But Joe has me beat there, I believe. And one of the things, though, that we're working on, at least with his strategy, is specifically for this week, he's saying that he's having a hard time finding volatility, which actually, Joe, fun fact with respect to the volatility thing, you were part of an inspiration for a video that I made that originally was going to come out in 2 weeks, but now it's actually going to come out this weekend. So it's just about finding options trades in low volatility. So maybe that will be useful for you. But anyways, back to your question on what do the wings do? The whole point of wings in a position is to make the position cheaper to put on so that prospectively you could put more on. So I'll go into on demand. The reason why I'll go into on demand is because this will help use like normal margin settings, which I think is important. I will reset the account from the example we were doing in GameStop before. And Joe, do you have any tickers that look good to you that like otherwise you would trade? Maybe it's too expensive or something like that. And now to be clear, I really don't like buying the wings. But in Joe's scenario, it's more of kind of finding a compromise, something that may or may not make sense. It may or may not work for him. But what I'm trying to do is just share another tool that he can use, really is the idea. So I'm going to see, I'm also going to move us closer in time to, let's do like last week, like the 17th. Tesla, perfect. Yeah, so we'll take a look at Tesla. Now, this is going to be back in time again. This is on demand, but it'll be good enough for kind of the conversation I want to have. I'm going to pause the time there so that it's not moving forward on us. And let's take a look. So, Joe, when you're making these positions right now, are you doing like what's your typical structure? How far out in time you going? And then what are you selling? I'm imagining it's puts, but I want to see so I can try to recreate. Are you doing something as short as the weeklies? And then I'll also turn this down weeklies. Yeah, okay. And you're using the near term week. Is that right? Because if so, I actually hate that, but we'll see if it is so or not. My guess would be yes. I'm going to forecast that yes, you're doing like the front week. But whether or not you are, to explain why that's not a great plan, I roll current week to next week. Yeah. So I think it's a giant mistake. I think the reason why you're doing that is because you're viewing options too linearly. And what I'm assuming is because you want the income for this week, you're thinking, I'm going to use these options that are for this week to give me that income. And I actually think that's a big mistake. Something that probably makes a lot more sense would be going further out in time and then simply take it down after a week if you want. But by going a little further out in time, one, you're going to collect more on the same amount of money. You're not going to actually make that money necessarily because you're going to take the trade down early. So you have to be careful when we're looking at theta, how much theta we're getting. So in this case, let's say that we're going to sell this 30 delta and theta on that is 33 cents, right? So we don't really care as a percentage here, although it will be much higher. Now, if instead, let's go out like maybe 32 days and let's find something like this. These are only getting 13 cents. So Wheel Search says most theta burn front week. Absolutely. There's no doubt about it. There's no doubt about it at all. But the problem is the way that that's structured is I've kind of already noted to you, it's very spoon to mouth. And the other problem that you have with this is although it is way higher theta, look at your gamma. Gamma in this case is 0.04. So these will change their P&L a lot very quick. Whereas if we go further out in time, your gamma literally is a fourth of that. It's 0.01. So that means as Tesla oscillates up and down $1, for example, your delta is only going to move in the 100th decimal. So it's not going to change that much. Whereas in this case, if Tesla moves $1, well, now your 30 delta becomes a 34 delta that's ready to ramp up even more pretty quickly. So I agree with you. And that's kind of it's part of a trade-off, which is why one of the things that might make more sense, in my opinion, could be adding wings to the position. But we can start with the front expiration if that's your preference. And so we would be selling puts here. And whenever we're selling these, let's go to analyze and let's take a peek at what this wants. I'm going to get rid of all this other crap that's in here. And then we want to look at selling this and see nothing apparently. That doesn't matter. So this shows the margin requirement on it is like $5,100. I don't know if that's accurate in like a non-portfolio margin account. I have no idea what the actual margin requirement is in it. I'm guessing it'll be around $5,100, whatever this is telling me. That's kind of why I wanted to use on demand. So under the assumption that that is the margin requirement-ish, what you can do then to unlock some money here is buy something that's super far out of the money, that's super cheap. The idea is not really trading it as a spread. It's still mostly treating it as a single option, but it's to decrease your buying power or really the margin requirement. So okay, cool. Thank you for the confirmation. So now if we analyze this trade and we get rid of this one, well, first let's start this one, right? So your margin requirement on that is $5,100. With the wing, it's $1,750. That's the point of buying wings in this scenario. You still can treat it as if it is a single option, but by purchasing the far out of the money wings, you can decrease how much money you have to put up for the trade. And again, in this case, you're taking it from 51.62 down to 17.50, much cheaper. And you can make it even cheaper still, or you can make it a little less cheap, but there's trade-offs to that because part of this position is literally giving up some of your profit. So in this case, again, just using the numbers that they're giving me here, we're going to collect about $1.74 and we're going to give up 14.5 cents. You'll probably have to come in at, to purchase, you'll probably have to come in towards the offer at 15. So you're going to have to give up $15 out of your 174, but you're decreasing your margin requirement by like $4,000-ish. So that's the point of this, is that it gives you another way to play this if you're not able to find the volatility that you want, because I'm assuming you're not cash securing most of these anyways, because if so, then you probably would be in a really bad spot if you get assigned, and then you have to hold that position because then your next week's income isn't going to line up for you. So my understanding is you probably wouldn't be taking assignment on them, and you'd be trading them as naked short puts, in which case something like the wings, Wheel Search says all cash or stock secured. That's, well, you can't, I don't get the stock secured part, TBH. I assume if you're selling the calls. The problem with the cash secured, and this goes back into a broader conversation about your approach, which I don't think we have to dissect necessarily super far detail. But the issue with the cash secured comment there is that if you get assigned, you're kind of fucked. And the reason for that is, sure, you might be able to sell a call the first week if you get a price accommodation, but there will be periods where you can't do that. So for example, let's go back here to the 1st of March. Well, let's go back further than that. Yeah, 1st of March is fine. Go back to March 1. Fast forward. And we take a look at, wait, did I mess that up? No, I'm super confused. Fine. This is fine. It's all fine. So if we take a look at March 1st, this is kind of what things look like. So now let's say that we sell whichever put that we want. We'll use the front expiration to play the game. And let's say we sell, I hate these weird strikes. So let's say that we go a little further out. Wheel Search just says, I've been lucky with Tesla rolling cover call weekly for plus 200 week last month or so. Yeah, exactly. And that's the thing, right? Is like, if we take a look at Tesla with where it is now, super range bound. So of course you'll be able to do that. You're getting still a pretty massive price accommodation. The kind of process that I was going to show you there, that is that like, if you had, for whatever reason, you sold your puts on the 1st of March for a week out, like, and we can finish that scenario, you run into a problem. Wheel Search says, yep, it's been great. Yeah, definitely. And I totally get that. I think the problem is that you're not thinking through the totality of the strategy in the long run. You're being way too spoon to mouth. Like, oh, I can get it this week, I'm good. Or, oh, I can get it this next week, I'm good. But the problem is sooner or later, this is going to create a pretty big problem for you when you mistime it. And one of the things I try to remind traders of as much as I can is that you have to pay attention to the path of returns. Trading is not a game of how much can I make this week or next week. Trading is a game of meeting your objectives literally over decades of time, long periods of time. So if you're overemphasized on like the short run performance because, you're meeting your needs, you're getting what you need, it's sooner or later, it's not going to work. And you will get into a bad spot, in my opinion. So I think the scenario here is probably not cash securing them. I actually don't think that makes sense in this scenario, or trading them as cash secured, because sooner or later you'll take assignment of something that doesn't work, unless there is another scenario that could work here. It doesn't have to be quite so binary. You could do the thing where if you get assigned, you then, let me see. What I'm trying to do is see, I'm just eyeballing the chart, and I want to see, like, if you get assigned somewhere, let's just model this other trade we were looking at, because I think it'll be a pretty good example. So let's go out 7 days from here, and then let's model this 195. Let's say you get 146 for it. Let's see what our numbers are in our fake account. So max loss, obviously. Yeah, so buying power effects like $5,300. You'll get 146 for your trade. So let's say we do that. We have that position on, and now let's fast forward the week and let's see what happens. I'm going to let all of this load for us. These Kroger watermelons are just off the charts good. It's crazy good. Yeah. Okay. So we're in the money big time, and it's looking real ugly. So Joe, I mean, let's use this as a scenario then, just to kind of play out the thesis. And to be clear, I know that you're a good sport about this. And also this is really great like information for you. So it's not like I feel bad. I'm giving you a ton of free game here. But I also think it's a good vector for other people to kind of understand this process of analyzing a strategy. And I really want this stuff to work out for you long term. So I'm happy to spend the time on it. So in your scenario, what happens here? You're about to get assigned on these 195 calls and Tesla is trading at 176. If we get assigned, we now will have 100 shares at 95 and whatever. Just call it 195. So I'm actually going to see if it'll let me buy them at 195. That would be really slick. It does not. Good old price improvement. It's kind of nice that they price improve it. So then what I'm going to do is actually reset this. So we'll pretend that you keep that, whatever we collected on that credit, doesn't matter. The $1.46. We got $1.46 to show for it, which is great. Now what I'm going to do is literally just keep this up and I'll throw this in the analyze. Nope, don't want that. We'll just keep that there. So now here's our position. You can't sell a call yet, then technically, because you're not assigned yet. We have to wait until Monday to do this. Now, again, if you're trying to optimize this and be more efficient, I would probably just sell the call right away because you know you're going to get assigned if the account can handle it. But we go in here, we go to Monday, and let's see where we're at. All right. So our 195s are up here. If you want to sell at the money, meaning at your basis, you're going to do it for 30 bucks. So you're now already unable probably to meet your income target because now we've tied up $19,500 in a dead position right now. And on this spoon to mouth cycle, you can only sell one call against it. Even if you want to get more aggressive and lock in a loss, that would be deferring a problem to another scenario. But let's just say that you keep it more conservative and you go right at your strike. In this case, you get 30 bucks. This is the problem with this. So, and this isn't even like using a terrible scenario from way back in the day. This is literally from a couple months ago it did this. So this is the concept of path. And this is also the concept that, at least in your structure, you have just no wiggle room to operate here. So it looks like you would get your 30 bucks. So let's do that. We'll sell them at 31. And then we'll go to the end of the week and see what it's looking like. I also, fun fact, have no idea why up here it says pre-buffering. It seems like the term buffering already covers that, right? Like do you buffer before you buffer? I always get a kick that they do that. To me, it seems like buffering would be fine, but no, it's pre-buffering. All right, so here we take a look and you're crushing it. You got your 30 bucks. And now we're going to look out to the next week. Go back to these 195s, and now you're going to get 13 cents. Again, this is the exact problem with this. Joe says, and repeat weekly. If premium is way too low, go out an additional week or so. Sure. So now we'll go out 2 weeks. Go to the 195s, and now you get back to 34 bucks. So now here's what's happened. We've tied up $19,500 in this position. After the previous week, you missed your income target. After the next 2 weeks, if you roll this out, you still miss your income target. The best part about this, and it's actually kind of inverse, it's the worst part, is if Tesla actually starts coming back alive, you have a covered call. You have no way to appreciate in the upside. So the max amount of money you can make on this position over the next 2 weeks, for example, following this approach, is $34, which is now we've missed our target 3 in a row. So I'll reset the account again, just so that we can track this by itself. And now let's fast forward those 2 weeks out to 28 March here. And let's see what we're doing. That was a pretty rough sell-off for Tesla. I saw this really, really interesting, where was it? There was this really interesting chart that I saw that showed the performance of EV companies. And I think, what was it? Fisker just reported bankruptcy as well. And Tesla's down massively from the top. I have to see if I can find that. So you got your $30. Tesla is now at 176. Now we try to go out another week. We go to the 195s. Now you get $61. I don't know how close that is to your income target, but I would guess that's still not it, because if you're selling stuff trying to get like somewhere around 150 bucks ish, you're still just going off of that assumption. You're still not at, you still haven't met mission here. You'd get $61 for a week. So now we're coming into an entire month of missing. So let's see how it goes. We sell this now for 61, and then we fast forward a week. And then I think at the end of this one, we can probably pivot to something else, because I think the point, at least hopefully, is somewhat clear to you. And then again, it's always up to the trader to figure out what makes sense for them. There's no substitute for that. But my goal is to try and help people view the entire landscape objectively and to provide information. And then whatever you choose to do, or however you choose to behave with that, it's up to you. Joe says, for this scenario, 120 a week would be target. Okay, cool. Yeah, so then you're not even at half that. And now we just passed another week. And, well, you would be at half that, sorry, for just this 1 week. So now that was what, 4 weeks we've missed mission. Now we're coming into a 5th week. We close this one out. We go out 7 days. We go to the 195s. And now for your 195s, you collect a resounding 5 pennies. So according to your methodology, we go out further to the 195s. Now you get 26 pennies. Is this would you go out further still, or would you stop at 2 weeks out of curiosity? Let's just see actually where you would have to go to get that 120 out of curiosity. I'm guessing like 40 something days. Okay, so 42, you would get 330. Come a little closer then, maybe 28, 195, 223, something like that. So if we go out 21, it's got to have some sort of event that's jacking up vol there like that. 160. Okay, so that's the closest so far, is going instead of the 19 April to the 26 April. This is where you would get at least something that would hit your first target. So now the question is, for the strategy, is that what you would do? Would you go out instead of 1 week, you would go out 21 days. Now, again, remember, this is just the raw number, right? Because this is now, we have to go essentially a month in order to get this. So if you amortize this over 21 days, you're still not there, right? So this 3 weeks, calendar days, not trading days, is 3 weeks. So if you amortize this over the 3 weeks, you're not there. Joe says, if I don't think the stock will hit strike by next roll expiry, I will consider going out a week more if the premium income. Okay, so you wouldn't go out this far. It sounds like you would go a week more. So this is 1 week. We're not even close. So then I assume you would go 2 weeks here, and then you would still be woefully underpaid now for a 5th week. So now let's fast forward this and see where we land after we pass 1 more week's time. And now for those listening in, I'm curious if this makes sense to you. Like, does this process make sense to you guys? This is not, to be very clear, how I would test a strategy. This is how I would just eyeball shit for a conversation. And the reason for that is I would back test this way ahead of time so I could look at a really large data sample before I go through this layer of detail, because this is really arduous, slow, and you can't collect a lot of information. Joe says, I would consider more than 2 weeks, but very often it won't be beneficial per week for income. Yeah, exactly. In this case, even if you go out, you couldn't go out far enough without going like 60 plus days before you could meet your target. So the 195s, they would probably expire worthless here. So we'll just say that you, again, collected the $20 or whatever. So now we're coming into a 6th week. of not going to meet mission. Let's go out here. And it looks like Tesla is now falling off a cliff. So you would collect the remaining 12 cents here. Happy days. And then let's see what would happen next. So a couple things I want to highlight while this is pre-buffering, whatever that means. The first thing is this is the problem of just holding shit. You can't just hold stuff. You have to have a plan, especially if you're kind of in someone like Joe's scenario here, where a big part of that plan is to be able to essentially make money on a weekly basis. We're now literally going deep into 6 weeks of not seeing the money at all. And not just that, it's worse than that, because you're not just not hitting your income target, but you bought something for $19,500, whatever it was, and now the market value is $14,700. That's not a trivial drop in the invested capital. So if we take a look at 19,500 to 14,700, it's a 25% decline in capital. So far, no good. So anyways, let's fast forward now again to a week. I'm sure the 195s literally won't pay us pretty much anything. Yep, you get 7 cents, so that's no good. Now we have to go out at least 2 weeks following the protocols. You get 21 cents. So now we're going into a 7th week. This would be 8 weeks because we just finished 6. Now we have to go out 2 to get really anything, and this is still nowhere even close. So I think you get the idea here. The whole point is that the strategy won't work. Like, that's what it boils down to. It will not work long run. That's straight up what I'm showing you, especially because, again, there's no room for error. If I need to make the money this week that I'm going to withdraw this week to live off of, this doesn't let you do it. That's what it comes down to. This is, again, what I refer to as return path. The issue with return path is it has to be respected. And exactly like we're talking about, this was a very happy path, right? It's been doing nothing. It's been flat. So then that begs the question, if there's some sort of methodology to make sure that you're only trading things when they're kind of flat, great. Then maybe you can come up with a consolidation period. I literally just built a consolidation period scan today, but for a slightly different purpose. But you can use that in stuff like this. But you can't, I really think if you're trading it the way that you are, the idea of cash securing it to me is just a huge miss, because you tie up capital. If it's a covered call, you don't even get the upside potential. I think it's problematic. Now, another scenario that we could play out much simpler is if, let's say, we go back to the 1st of March. Because, I mean, as I look at that, you're still not even back to break even in that scenario. And that's not even buying it at the high, right? That's not even top ticking it. This is getting it during a very reasonable point in time. At this point, it was moving higher. Like, this isn't, I'm not picking the worst scenario that you could on the chart. I'm picking a very fair scenario. And in this case, I notice we're still not back yet. So here's what I think right out of the gate, based on the breadth of studying that I've done. One of the very first rules I would probably look to apply is a moving average, a 50-day, a 22-day, a 21-day, some sort of moving average rule that precludes that product for an entry on a cash secured style trade until it's trading above that moving average. You can reduce so much pain by following that simple of a rule set. So if you use something like a 50-day moving average for something like this, which to me, I would be very picky. There's no reason not to be picky. I would pick above some sort of, probably, well, if you're doing it on a weekly basis, I would want 21-day above the 50, price above both. That's what I would look at. That's my guess. So you can apply a simple moving average rule set that's not going to completely save you, but it will reduce this unnecessary drawdown. Also, quick shout out to you guys. We got over 40 people chilling here, learning about options. I love to see it. Makes me so stoked. We also have another beginners workshop this Friday. So if you guys didn't know about that, that is coming up. I actually think that's on our little doodad here. Yeah, right there. This will be part 4. And for part 4, we're looking at analyzing an options chain. And then there's a couple specific questions people have sent in that we're going to take a look at, but that's next. So yeah, Joe, obviously I'm happy to talk more about it. I can just tell you right out of the gate that it's really just not a good idea. And what makes me even more concerned beyond really your entire life is the fact that I know that you kind of need this money. And I'm looking at something that essentially is going to have a failure. Like, it's going to fail. I know it's going to fail. And I don't like that. It makes me uncomfortable. But you're a grown-ass man. You're going to do whatever you want. So I really, really hope that we can talk about a different approach. Like I said, integrating is something as simple as moving averages. If it's above a 50-day, rock and roll. If it is not, then we need something else. Because if you do that, it will generally keep you out of these. You're not going to completely escape these drawdowns. But what you will do is not get stuck at $240 while something is still down here at 182 on something that you need weekly income from. So you will eat a loss. It will be a realized loss and it'll be kind of lame, but you will be out with your life and onto something else. So if we go back here real quick to like this, 4 Jan, take a quick look, see at 4 Jan. And I want to show you something. Boom, boom. Pause. So the reason why I'm going back to 4 Jan like this is because it'll give us a better view of these moving averages. And I can squish this down so you don't have to see all that noise right now. It doesn't necessarily matter. And if you use something as simple as a 50-day moving average, essentially you're trading all of this. You trade this, you probably trade this, you get stuck somewhere in here. So like maybe like the 283 handle, something like that. Which one of these is a Friday? We could find the closest Friday. 14 to 17, this one. So in case you guys didn't know, YouTube wants me to insert an ad, but I never do that. I just hit close and they can go screw themselves. I don't like dropping ads in the middle of live streams. I think it's super annoying. So I willingly look at money for you guys and say, no, I don't want to do that. Anyways, back to my point. Let's take a peek at this Friday. So this is where you probably would have entered in-ish. And I'm guessing the put would probably be something around like a 250, 260. So let's call it like a 255, something like that. So then we get this big drop and then it trends sideways. Essentially, you might not even get assigned here, depending on how close we are. But then if you start going to sell again, let's say you get assigned somewhere in here. Essentially, what you do in this scenario is you decrease how much of this drop you eat, but then you get out. You're flat when it drops below the 50 conservatively. You wait until you get some sort of convincing move up above to get back in. You wait here. There's no signal. Pop up here. You're still trading it. And then you get out here again. You don't trade in here. You catch this. You get whipsawed out again. This is in here, the downside of moving averages. And this is the decision that you have to make. You can use a really short-term moving average like 10, 21, 50, kind of 50 is more midterm. And the longer term moving average, the fewer signals you're going to get. So it reduces this kind of whipsaw, but the bigger drop you're going to experience. So for like a weekly strategy, I actually would probably use something like this, like a 21-day MA. And then as soon as it drops below the 21-day, I'm out of there and I'm going to move on to something else. And it essentially will take you out of the majority of this slop. And the most important part about this strategy, the most important part about this filter is that you have now not entered in here and you are not still waiting for this thing to come back. That's kind of the punchline scenario here. Because again, going back to this specific scenario, we already know if you get stuck here and it starts trading even down here, you can't get your money, meaning selling calls against the shares. You can't even get your money here, let alone going from here to here. You're just eating a loss. What will happen sometimes, to kind of bring the point home, you will get whipsawed. You will realize a loss in some of these instances. It's still nothing like what you're experiencing here. So to me, it's a worthwhile trade-off. And especially for somebody like Joe that is using this for income, to me, protecting that principal is so freaking important. You need the principal active in order to literally survive. So I think we have now beat this horse pretty far to death. As you guys can tell, I do care about Joe. I do want him to find something that works for him. This ain't it, is what that boils down to. And I'm always happy to try to talk and help, discuss different things that can be, but this is not it. All right. There was a couple other questions I saw further up. Let's take a peek. Let's see. And we also now know what wings do in a position, which is really good. Carlos says GME falling wedge 2 hour must be news pending. No way it pops without some news. Let's see. I think the problem, honestly, with GameStop when it comes to any sort of technical analysis, I ran a really large data set against it. It's not very predictive. It's actually kind of really unpredictable. There's a lot of reversals baked into it based on the different tools that I was looking at. It's because the way that this thing moves is so different. So I think it's really, really difficult to apply standard supply and demand style oriented technical analysis, which is really the base of technical analysis. I think it's really difficult to apply that successfully in something like this personally. So to me, it could have that wedge, but I personally wouldn't read a ton into the wedge. Although I will caveat, right? One, this is my opinion. It's always important to understand my opinion is not rule. This absolutely could love the wedge and fly off a handle. Could do that. And the other thing I definitely have seen is Roaring Kitty use some drawings on his chart. I honestly think some of it is because he's kind of playing around. I don't actually think he's doing a lot of that. I think most of what he's doing in this is understanding the underlying forces that move price in it. And I think he's playing way more on that. That's based on what I've seen so far. But yeah, anyways, it's an interesting idea. All right, let's see a couple other questions so I can get caught up. James says, I tend to underestimate the risks of holding an assignment. I am not fully appreciating the opportunity cost holding much capital and underlying with so much risk attached. Yep, that's exactly it. That's literally exactly it. And it's because we have such a skewed way of analyzing markets. That's one of like the complete reconfigurations that you have to go through to be a successful trader in this long term, is not looking at the optimal scenario. It's almost like you dismiss the optimal scenario. You know it's there. Like for, again, going back to the previous example in Tesla, we want it to go up. That's the optimal scenario. The probabilities of it going up typically are pretty good, but the thing that will hurt you is when it doesn't do the optimal outcome. So to me, the most important part of a rigorous approach to trading is spending way more time analyzing the part of the trade that we don't want to look at, the ugly part of the trade. That's how you stay in this business long term. It's not by looking at what we want to happen and then just hoping that that happens. It's a terrible approach. Hope does not work well in stuff like this. So yeah, it's literally a really, really great point, James. Elong Song says, I got to sign on 2 positions Friday unexpectedly because I did not do the math on rolling. Oh, interesting. I'm really curious what happened there. Moody Blues says, can you look at NVIDIA's chart? Seems to be oversold. You know we can look at some NVIDIA. Got to be careful saying oversold, but it is coming off a bit of a cliff here, that's for sure. So, and this actually segues into a position update for me, which is this. I have essentially flattened, well, it's not essentially, I have flattened the Q's, T-triple-Q's position. And I think right now I just have some puts and some short calls. Pretty much it. All the shares came back down, and this is actually applying all of that shit that I was talking about before with some of these momentum style strategies. You can see all these different parts that I'm interested in seeing. And yeah, I mean, that's essentially what's going on. So in something like Q's, what I'll do at this point is either wait and see how it behaves in between this level but there is a pretty fair probability that I would have no problem getting back in if it starts ticking back above this 10-day moving average, but I would need it above that. And the reason for that is the 10-day moving average still has worked well on shorter term durations than TQQs. TQQs is a different beast. I cannot overemphasize how much of a different beast this is. Also, I need to update the title to this because now I know what we're talking about, which is analyzing option strategies. And for teachable cues here, the downside decay is massive. You have to be super, super careful with that. And I think that's one of the problem that like the people that see the really good returns that TQQs can provide, but again, they ignore the path. They're too comfortable looking at the happy scenario, it doing what we want. But then as soon as you start taking a look at it doing the stuff that we don't want it to do, it actually gets really ugly really fast. And I will help you guys see this. I don't know why this lady always pops up. It actually gets kind of annoying. She looks really nice, but she's also super annoying. And let me get rid of all these. And we'll drop 100 here. And I want to give you 3 different scenarios. QQQ, QLD, T-trips. We'll do 100 and then 100. Let's take a peekaboo. So here's the problem. You look at TQQs and you're like, wow, a 34% CAGR. That sounds sick. That's literally better than my return via just buy and hold. It's actually kind of offensive. But during that buy and hold process, guess what? You have to watch your money disappear by to the tune of 80%. So you take your total pot of money that you've made at some point, and then you remove 80%. You light it on fire and it's gone. That's the difficulty with this. Now you can make path way better. I'm not even trying to drag the concept of buying and holding TQQs. It's completely fine. You actually just need to programmatically make sure you include something like dollar cost averaging in on a regular basis so that when it's going through these more aggressive drawdown periods, you're scaling in capital when it's cheap. And you can do that. And it literally can work really well. I want to be super clear. You still have to be ready to watch your money drop by 80%. If you cannot sit down, literally sit down, envision your account, envision the morning, the way that you wake up, whatever you do, then whenever you end up looking at your account, whether it's on a computer or on your phone, literally think about it. The problem is so many people, myself included, for a really long time, we just brush over the ugly thing. You're like, oh, well, 79% sucks. That's not great, but 34% CAGR, that's awesome. It is awesome. But if you don't go through the process of like truly placing yourself in that scenario and thinking what you would think, I literally would go through the exercise in depth with myself. And that's why I know for myself, this is a better return than I can generate right now. This is better than my compound annual growth rate from when I started trading in 2007. And I have a good return. Not great, but it's good. This beats it by doing nothing, by just holding it. But I can tell you this, I did that exercise I was telling you about. This ain't happening, bro. I'm not opening up my account and seeing the money gone by 79%. Why is that? It's because then you have to wait a really long time before this comes back to break even. And more importantly than that, who knows when I need the money for what? I'm at a point where I'm not willing to go through a 79% drawdown on the account. Now, this opens up a whole other conversation about how you can trade leveraged products. You don't need to use as much money in something like this to get such a great return. You can size down massively from the amount of money that you would put into something else, all that kind of stuff. And this is all a massive offshoot from the original question asked, which I'm going to go back to now. I just wanted this part to be really clear because it dovetails off of that other conversation we were having about not spending so much time looking at the scenario that you want to happen. Spend way more of your time and effort looking at the scenario that you don't want to happen and how you would then react to it. Because what you'll notice is something like a Sortino ratio actually looks way better in Qs, which means you could lever this. Even something like QLD, For a while, I used to run different kinds of momentum strategies in both of these, but you can lever up on something like this. So you have to figure out what works for you. But what I'm going to leave the note on here is the path matters. Don't ignore the path. Don't gloss over the path. Pay attention to the path. That's that. All right. Back up to the questions. DeSwag says, I really like your cover strangle strategy. Yeah, man, that's a go-to for me. I'm trading a bunch of them right now, for sure. Oh yeah, let's go back to now NVIDIA. All right, at a glance, I see a bunch of things going on, actually some that are like legitimately a little bit concerning. The very first one is notice the sale volume jacking up here. That's really, really big. Today's sale volume, or today's options volume, vast majority was sale volume, 99%, which is huge. Absolutely huge. I don't love that. I also don't love how NASDAQ net highs lows is still kind of stagnating. I don't love that it's trending in the negative, because this obviously is kind of close to that. I don't like the moving averages here. So long story short, this is not where I'm buying NVIDIA personally. This is not where I would buy. The very first place I would start to get interested, the very first place would be kind of something above this, which is literally just using a midterm moving average. That one's a 21-day moving average. The next place I get interested, let me see. Right now I'm looking for volume nodes. I'm trying to see if there's any interesting volume nodes. Here, that's interesting. So this is the next large volume node is right there, which is right about where we're looking. So that's where it starts to look interesting to me personally, is when it gets above that. And then for me, the strategy actually becomes really simple. It literally just becomes, again, a moving average follow, right? So in this case, on a daily, I would just say, okay, if we get a clean break up above this and it looks like there's strong momentum, then sure, I take the trade. And then the stop would be really tight. The stop would be hovering right around 119.5, right where this moving average is. So I do think that it looks frothy. It looks like there's a lot of capital that's flowed into it, and it looks like it's due for a pullback. Even something that's as strong as NVIDIA, they go through pullbacks, right? Like this. This is a quintessential pattern. So something you guys should get used to seeing in markets are products that make moves like this. Right here, it went from 48, it peaked out to 95. It essentially doubled. Big, big, big move. Then it trends sideways for a while. Sooner or later, it has a breakout. Big, big breakout. It's coming down. For me, I wait until this starts trending sideways again. Then I start waiting for a breakout. That's essentially the protocol that I follow and stuff like this, and it works really, really well. It's exactly what I would do in here. This isn't something that I would want to short. You could short it. I would make sure that it's some sort of defined risk though. I wouldn't have a undefined short. I'm not shorting calls in here. It's not super gappy, but to me, it's just, you're not getting paid enough for what that risk would potentially entail. So yeah, overall, I agree with the hypothesis that NVIDIA looks a bit heavy. Massive call volume though. Look at this freaking call skew. 2 million calls against 2.7 million puts. That is no joke. That is a huge, huge, huge call skew. And again, to remind everybody, typically it's the opposite. Typically you see put skew where there's more puts because people are hedging to the downside. So there's so many people here that are speculating right now to the upside that there's no ifs, ands, or buts about it. Looking at the out of the money vol, put skew as per usual. So nothing novel here. I mostly see put skew. I do see some kinks, as I always talk about. You can trade those, but that looks okay. And then let's take a look at not volume, open interest. About the same. That's very curious to me. So this is way more normal of a relationship between OI, puts and calls. Generally, you would see more puts than calls. And in this case, you don't, but it's super close. So that's also really interesting to me. But there is massive, massive call volume today. And again, this tool is down based on the video that I launched earlier. It's still not back up, which is annoying, which I want to take a look at it. that's that. Unapologetically honest critic. Ooh, an honest critic. Always down for that. Take a look at CLSK or Kava. Sure, let's take a peek. CLSK. So the very first thing that comes to mind when I look at this is what I would call non-discrete information, which is really interesting. That's kind of a problem for momentum style strategies, but that's the first thing that's like the very first thing that jumps out to me. Non-discrete information for sure. Let's take a look. I don't know this product quite as well. So what I'll do is grab this so that I can get a little closer acquainted with it. And then let's see, I want details. And then let's take a look at CLSK. All right. Massive revenue growth. That's pretty cool. Massive revenue growth. Decent short float. That's not an insignificant amount, 15.74%. Actually, let's take a look at that. Days to cover is super quick, so that I don't care about. From a fundamental perspective, I'm mixed on it. From a technical perspective, it's not doing much right now, year to date. Let's see. We'll come out here to like a 1 year. Yeah, so it looks like it's made like the vast majority of its move. And then it's kind of been in this 10-point range for a hot minute. Erik. Yo, what up? Also, sick name. No, it's not a loop, dog. I am here live. I'm just answering somebody's question and giving it the attention it deserves. Yeah. So this I don't dislike, but it's not moving quite as much for me. So like this consolidation is good. This kind of really big breakup is really, really good. Non-discrete information I don't love for momentum strategies. There's a really high probability of whipsaw, but I do see slightly, ever so slightly, successive higher lows. So it is somewhat basing, but like not a ton. And it's definitely starting to trend back down here. So yeah, I mean, this is something that like I would look at, but this isn't something that I feel any significant conviction on. Now, the other thing though that I would take a peek at is what it looks like from a vol perspective, which is very good. That's exactly what I was expecting to see. So from a volatility trading perspective, it looks pretty good near term. So the 30-day VRP is really strong. I'll get myself out of the way for you guys. The 30-day VRP is really strong. The short-term VRP is weakening, but still there. So this would also be kind of a variance risk premium style play. But yeah, I don't hate that one. And then Kava. Let's take a peek at some Kava. This is something we've obviously looked at before because I have an existing line on it. I don't know the last time I traded it. I already see a really strong volume node right here. So this would be like a at or below for kind of like a breakdown. And then for the upside, let's see, I'm into like a 3-month. 97 versus 90. I would probably want to see some actual strength here. His volume is kind of anemic right now. Really nothing like what we were seeing here. Definitely more discrete information, which I like. Not a ton of long-term variance risk premium. Definitely more opportunity for short-term VRP. Yeah, but this looks a little bit more like an upside play to me. it looks like it needs to base a little bit, right? So it looks like, again, following that same pattern I showed you guys before, we have this big giant surge here. Then we start trending sideways like this. And then we eventually get some sort of breakup up and out. Then we assume the next leg. This looks like it's entering another consolidation period to me before I would expect to see it kind of follow along, provided that there's no massive change in technicalities. James Wu says, what do you mean by discrete information? Great question. So the way you can think about candles is essentially their information. This is just the aggregate pricing that people are integrating into a product. And I'm reaching over to my phone because I have to launch my dinner order, man. We haven't eaten yet. We're going to do some Greek food tonight. Place that. Now back to this. Candles are information. Big, wide, choppy candles is typically non-discrete information, meaning sometimes new information comes out, then it's lull, then overreaction, underreaction, which are both two behavioral tendencies for traders. It creates opportunities, but it's kind of more noise is the way to think about it. So discrete information, like it's a little more discrete. It's not super discrete, but you'll notice that there's way more of a trending component. The wicks don't have, or the candles don't have these crazy long wicks all over the place. Whereas if we look at that other thing, where is the name? CLSK, kind of the opposite, right? We're like chopping up and down. A lot of these candles have at least some kind of meaningful wick on it. So it's just way less discrete pricing happening in the product. So that's the primary way, the primary difference between those. The reason why that matters is specifically in terms of momentum following strategies. We want more discrete information. It tends to work well because there's not as much whipsaw. That's the kind of the punchline there. All right, back up to the top. Erik, we are over to you, my semi-impatient friend. But I have to be honest, you have the same name as me, and I'm also super not patient, so I feel you. But you're looking at PLTR. Let's see, PLTR. Oh, interesting. Mixed. That's my knee-jerk reaction to this. Mixed feelings. Oh man, this is, I can't necessarily immediately make heads or tails of it, which typically makes me not love it. Wow, this thing is all over the place, isn't it? Let me see. Let's go out like really far. Huh. Yeah, I mean, I can see some upside here, but I just really don't love it. So for me, it would be more so looking at something there, but yeah, I don't love it. I would need to see it break through this volume node. I would need to see it start at least breaking above this previous resistance level from before. But for me, I would probably pass on it, especially with earnings coming up. This isn't something that I personally would trade long calls in. That's not to say that it couldn't work, but I just don't like what I'm seeing. I look for way more definitive style trends than something like this that's just like chopping sideways. It's running into near-term resistance. It just set more near-term resistance. It has slightly lower highs. Yeah, it just looks kind of messy. So, and again, just because it's messy doesn't mean that it couldn't work, but it also doesn't lead me to be necessarily very jazzed about it. So you could call it, you know, that it's coming into a wedge. Yeah, for me personally, this would be probably a pass. I would want to wait and see what it does here, if it starts to consolidating or break up and out. And more importantly than that, the way that I look at trades personally is I'm looking for no's. I'm not looking for yeses. So what that means is I'm really spending a lot more time trying to like deeply analyze the position and what I would want it to do, what kind of position I would put on in that context, what makes sense for the position that I want to put on, and not trying to force a trade because of one reason or another. I am generally product indifferent. There's a lot of things that you can trade out there. So all that being said, I don't love this one. So that's where I'm at here. Let's see what else you guys got. Elong Song says, I've been rolling for a few months, didn't fully understand how to calculate it all up correctly. Then I watched your video on rolling, which showed me how to, I see. Okay. Actually, Elong Songs, I'd be curious even to click into that more. We don't have to do it now, but even in the Discord if you want, because I'm curious how you were thinking about it before. That kind of information is useful for me because I remind you guys sometimes, like, I've been trading for so long, I've developed a different way of thinking about markets. It's just a natural component of doing this. So it helps me to understand better, like, how you guys are looking at the market, because it helps inform the kind of stuff that I make that may be useful for you. Mad One says, so on this idea, are you talking about you can now do this with distribution based on ETFs, so your generation cash flow while it's doing the drawdown? I assume you're talking about something else, probably what Joe is talking about, right, Mad One? Nick says, how do options look for AMC? Ivy is dead. Yeah, let's see. A couple people have asked me to look at AMC. I haven't done it yet, but I mean, I'm happy to. Yeesh. I mean, this is interesting. The fact that it participated that much actually surprises me. IV's at 117, low IV percentile 26%. Doesn't look that attractive from a vol trading perspective. Volume is essentially dead. Volume is really low. Super heavy sale volume. Today was like the first even shred of green volume, and it's just a little tiny baby candle. Volume today was 15 million, whereas the average that it's coming down from is what, like 53 million, I think. So that doesn't look great. And yeah, let's take a look at the chain. That's interesting right there. Like, right, that jumps out to me immediately. That we're 126, 114, 12, 18, 12, 11, 15, 128. Actually, the highest vol in the chain so far is here, and then it goes down and then pops back up here. Like, that's all actually very interesting to me. This looks like because of the special dividend thing that they have coming out, so this one makes more sense. This one doesn't. This one is actually a really strange expiration. 179 days to go. Why are these so high? This is weird to me. Really, really small options chains, though. There's just not a whole lot going on here. Let's take a look at total OI. Big call volume. Really big call volume here. So across the entire chain, it says 857,000 calls against 265, which that's really interesting. And if I try to see where most of these are, there's 90,000 in 16 Jan 26, way out here, which that's actually not a terribly placed position. I don't love the trade because it's only at 4.5. So to get 20s, obviously you're kind of expecting a huge move. But these will still move a little bit. They're a 30 delta with a 6 gamma, so it's not that bad. I didn't expect those to look like that. Yeah, I don't hate that. 30 delta, that's not bad. Take a look at the vol. Put skew, mostly put skew. So mostly being priced into the downside, as far as I see. Again, another scenario. I wish this was up and working, but it's not. So cannot look at that. We could take a look, stroll through the chain today. Standard bunch of YOLOs coming out here. Nothing. 28 June, 8.5s. The 28 June, 3 puts for a penny. Yeah. So, I mean, this is kind of just prospecting. There isn't anything special going on here. And with something that's so cheap like this, you kind of have to even size up a bit in terms of what we're looking at. So at least 500. At least there's no spreads. And of the larger positions, I see 2 put transactions and then 4 call transactions. So a little more being priced in, at least in terms of the larger transactions, but none of these look informed to me because they're all very, very small, very, very small. So yeah, I mean, in general, it looks overall pretty uneventful to me, if I'm being completely honest. Yeah, I don't really see a whole lot in here that looks super interesting to me. These don't have a lot of OI. These do relatively, but again, this is just kind of cheap YOLOs and still relatively on the small side. These look kind of interesting. Now this part is a little interesting. 4 days to go, 17,000 OI and 18,500 on the volume. So this is still buy volume, that's for sure. And the other interesting thing about the buy volume here, again, we don't know how much of it's buy volume, but definitely some of it without a doubt. And the interesting thing about this from kind of a broader market perspective is if you think about this position, right now, the market makers on something like this, they're not super hedged. They're a 22 delta, so they're not going to be grossly over hedged here. Now, if this starts to move and get into the money, they're going to have to start buying shares at a pretty massive rate in order to maintain their hedge going into expiration if these fell in the money. Now, as I look at the current pricing probability of it falling in the money, it's only 38.5. That's for a touch. So it's still smaller probability of that happening. But if it did, this is at least a somewhat sizable enough position to make it at least somewhat interesting, but it's not big enough to like cause some sort of parabolic gamma ramp. I don't see that happening here. But the fact that these are 22 delta, that there's just 4 days to go, if for whatever reason there was a decent price accommodation here, that does start to get a little interesting. But at a high level, that's all I see. Nothing too much. Trey J, what up? It's good to see you. I'm glad you made it. Matt Ledger just joined, starting from the beginning, but wanted to shout out. Really appreciate your analysis, mentality, looking at the market. Yeah, for sure. Refreshing this toxic trading YouTube environment. That's the funniest part, man. It's like the reason why I started doing this. I obviously don't have a face for camera, and I don't like social media, as you could tell from any of my social media platforms. But a big driving factor when it started to gain traction after the original purpose of launching the channel was literally because of that. I think it's easy to not like what other people do, but I'm really against just complaining about things and not offering at least an attempt at an alternative. So that's what I do. I try to just talk about markets as I see them, but to give kind of a more realistic and healthy way of interacting with markets compared to what I typically see, which I generally identify as super unhealthy. I think most platforms I see are so incredibly predatorial, it drives me crazy, because I find the vast majority of people that interact with YouTube videos on trading are the exact kind of people that don't have a bunch of money to light on fire, to give away. And I think that that's really messed up when people try essentially to monetize them to any degree that they can to make a few bucks off of them, when it's the exact kind of group of people that don't have the money to give up. I don't like that. So yeah, it's exactly why I started this kind of thing. Richmond says, glad to find you live. Been following a minute and love the analysis. Yeah, I love doing this stuff live. And actually, you guys have been really good at coaching me, to be honest, because I typically don't do a lot of the like train of thought stuff. I generally want to like synthesize what I'm looking at and then like give a synopsis. But a few people have mentioned that like the train of thought is useful. So you got to give a shout out to a lot of other folks that have kind of let me know that that's helpful for you guys. So that's that. Yeah, kind of boring in AMC right now. This I need to figure out though. This is something I will look at. Something from a market perspective, this tells me something's happening here. I don't know what, but something is. You don't go from 126 down to 111 and then pop up 115, 128. Like something is weird here. So those are the kind of things that I know to look at and to try to key into just a little bit, because yeah, like there's something quirky about this expiration cycle. I don't exactly know what it is yet, but yeah, interesting. The working investor, love your channel Discord, brings so much value. That's awesome to hear. That's literally exactly the goal. The 6 say, just left a comment on today's video, say you should stream during live market hours and you're currently streaming. Yeah, I don't necessarily stream too much during market hours for a few reasons, to be honest. I think a big part of it is like either I'm trading and like doing the job that I'm supposed to do, or I'm honestly out doing other shit. Like I don't sit in front of the screen, especially all day during market hours. In my opinion, the overwhelming majority of the work as a trader is done during off market hours. It's looking at data sets, it's looking at trends, it's optimizing strategies. What I try to impress upon people is like, once you build the skill set, the actual act of trading, and I don't mean this hyperbolic, like it should be easy. It literally should be easy, because all of the hard work is done before you place a trade. When it's time to place a trade, you literally could train a monkey to hit the buttons for you. Like all of the work is done. So I think that's why I tend to try to host these at times that are a little more advantageous for me. But I also think beyond that, I try to accommodate a lot of people. At least I know for my community, most people have day jobs. So the ability to watch like during the day can be really challenging for folks. But it's something I would consider. Like if people would be interested in it and there's a reasonable time to do it, I'm happy to. But yeah, at least right now, that's why I structure these to be specifically after market hours, later in the day, so that it's a little bit easier. Yeah, a little bit easier to catch up with folks. 6 says, was going to pay for Unusual Whale sub, but didn't know Toss had option sales feed. Thanks for that. Yeah, definitely. I think for an Unusual Whales, I actually reached out to them because I think I'm going to try and like review their tool more in depth. The fact of the matter is like right now I already have like an affiliate relationship with Bar Chart because I like their tools a lot, and also Benzinga. And for both of them, they offer kind of different versions of those already that I like, but Unusual Whales looks cool. The problem I have is that like unusual options activity or trying to like watch options flow, it's useful, but I think it's grossly overemphasized. Like I think people think that there are like huge edges to be extracted in there, and there can be, to be very clear, like you can capitalize on flow and specifically seeing, you know, like big block orders, just standard unusual options activity, but you can get that kind of anywhere, right? Like even this. What I typically will do is scan for what kind of trades happened in a day. I'll even pop over to the trade grid, drop in individual options in here to take a look at those and see how they're trending. And then you can kind of summarize essentially everything that you need to see in general here. Now, some of this doesn't have the same historical rigor, which is the one part I don't like. But in general, I have to kind of pop through a few different things or track it. Like that's what I'm doing with all the GameStop stuff right now, is I'm manually tracking it so I can stay abreast of it. But yeah, I think the tools that Thinkorswim offers are pretty solid. All right, you guys, It has been a hot minute, hour 15, a little long for a live session, but I'm always down to hang out with y'all. We have the pro market prep on Wednesday, and then Friday is the next beginner options series episode. Friday at 5 Pacific time. That one's going to go through kind of this stuff, actually, looking more deeply at the options chain, figuring out how to draw inferences from options pricing. They're very informed markets, so you can learn a lot from them. And then I'm hitting kind of the different questions I see people dropping in from the last one, this one. So if you have specific questions that you want me to walk through in the beginner series, just let me know. You can throw it in a comment. Happy to take a look. Be an outlier. Make good decisions. I'll see you guys out there.